All right, let's talk about something that sounds super complicated but actually hits really close to home. Bank capital rules. I know, it sounds a little dry, but stick with me. The Federal Reserve is about to give the rulebook for America's biggest banks a major overhaul, and we're going to unpack what that actually means for, the real economy, your economy.
So why should you even care, right? I mean, this feels like it's a world away. But here's the thing. These rules, they have a direct line to your wallet. We're talking about how easy or how hard it is to get a mortgage for a new home or a loan to start that business you've been dreaming of. This stuff is the bedrock of our whole economy. It's not just about Wall Street, it's literally about your street.
Okay, so here's how we're going to tackle this. First, we'll look at why the current system is under a bit of strain. Then we'll get into the modernization plan itself, breaking down all the proposed reforms. And we'll wrap up by asking the big question, are these actually smarter rules for a stronger economy? Let's get to it.
All right, first up, a system under strain. Look, to really get what the Fed is trying to do, we have to understand the problem they're trying to solve. The rules we have now, they came out of the 2008 financial crisis, and they were absolutely necessary. But now, over a decade later, well, they're starting to cause some new problems of their own. So after 2008, the name of the game was safety. Regulators made banks hold way more capital. And honestly, that made the system a lot more stable, no question about it. But the way they did it created this kind of tangled web of rules on top of rules. And now some of those rules are actually working against each other.
And this quote from Federal Reserve Governor Michelle Bowman really nails it. She's saying, hey, just piling on more and more capital for the sake of it, that's not free. It has a real cost to the economy. If the rules aren't tied to a bank's actual risk, you can end up choking off growth.
And these aren't just abstract ideas. We're talking about real consequences. For one, it can make it harder for you to get a loan. It also has this weird side effect of pushing normal banking stuff, like mortgages, out of the well-regulated banks and into the shadow banking sector, which is not ideal. And of course, it just adds layers of complexity and cost that don't always connect back to making the system safer.
Okay, so that's the problem. What's the solution? Enter the Fed's modernization plan. The big idea here isn't to weaken the rules or go back to the pre-2008 days, not at all. It's about making the system smarter, more tuned in to actual risk, and just more efficient.
Hang on, before we get any deeper, let's make sure we're on the same page with this term bank capital. Just think of it like your car's suspension. It's a financial cushion, a shock absorber for the bank. It's there to soak up any unexpected losses so the bank doesn't go bust. Now, you want a good cushion, for sure, but if it's too beefy, the car gets sluggish. Same with a bank. If it has to hold too much capital, it can't lend that money out to people and businesses.
And that's really the whole point of this new plan. It's about right-sizing those financial cushions. The goal is to make sure a bank's capital is a true reflection of the actual risk it's taking on, not just based on some one-size-fits-all rule. When you do that, you free up the bank to do what it's supposed to do, fuel the real economy.
All right, let's get into the nitty-gritty. How does this whole thing actually work? What are they proposing to change?
So the whole plan is built around reforming four main areas. You've got stress testing, the supplementary leverage ratio, the Basel III framework, and something called the G-SIB surcharge. Now, they're all important, but we're really going to zoom in on those last two, Basel III and the G-SIB surcharge, because that's where some of the biggest changes are happening.
Okay, this is a big one. One of the most important changes is just about simplification. Right now, believe it or not, the biggest banks have to do two totally separate, mind-numbingly complex calculations to figure out how much capital they need. It's redundant, and it's a huge waste of resources.
So the proposal basically says, let's stop this madness. Instead of the old way with two different competing calculations, we move to a single, streamlined approach. The goal is to cut out the complexity and the extra work, but, and this is key, without making the system any less safe.
And inside that new single approach, the rules get a lot smarter. So for credit risk, they'll look more closely at things like the loan-to-value ratio on a mortgage. For operational risk, the rules will be better tailored to how U.S. banks actually operate. It's really about using a scalpel instead of a sledgehammer. More precision, less blunt force.
All right, let's talk about that G-SIB surcharge. G-SIB stands for Globally Systemically Important Banks, which is just a fancy way of saying the absolute biggest, most interconnected banks, the ones that are too big to fail. So this surcharge is an extra layer of capital they have to hold. It's like an extra insurance policy that the rest of us don't have to pay for.
But here's the catch. That surcharge has been growing and growing, but not necessarily because the banks are taking on more risk.
It's been going up almost automatically, just because the economy is getting bigger and because of inflation. So the measure has kind of lost its way. It's become disconnected from what it was supposed to be measuring in the first place.
So the proposal lays out a few common-sense fixes for this. First, they want to tie the surcharge to economic growth, so it stops growing on autopilot. They'll also fix some of the math on how risk is calculated, use yearly averages instead of a single snapshot at the end of the year, which can be manipulated, and they'll make the increases more gradual to avoid these huge, sudden capital shocks. Okay, we've been deep in the weeds, so let's pull back. What does all of this mean when you put it together? What's the bottom line for the economy? Let's look at the big picture. So if you look at the numbers, what's fascinating is that after all these changes, the net effect is pretty small. The Basel III stuff might nudge capital requirements up a tiny bit, but fixing that G-SIB surcharge brings them down a bit more. When you mix it all together, you get a slight decrease overall. So this isn't some massive change in capital levels, it's more like a careful recalibration.
And this is why it really matters. The whole point is to make the rules smart enough so that essential things like getting a mortgage or a business loan happen inside the normal, regulated banking system. The goal is to keep that activity in the light, where it's safe and supervised, instead of pushing it out into the shadows.
And this quote sums it all up perfectly. It's about finding that sweet spot. You want banks to be tough enough to handle losses, to be resilient, but you also need them to be able to do their main job, which is lending money to households and businesses. It's a two-sided coin, safety and service.
Which brings us to the big final question. This entire proposal is about striking a balance. But it makes you think, right? Can you ever create a set of rules that is 100% safe and 100% efficient for economic growth? Or is regulating finance always going to be a delicate dance, a constant trade-off between those two essential goals?